Okay, let's unpack this. We are diving deep into the Simply Good Foods company, that's ticker SMPL, right after their Q4 fiscal year 2025 earnings call. This one happened pre-market October 23rd, and it immediately sent the stock tumbling. We saw plunges, close to 20%. So our mission today is to get past those headlines and really understand what's going on under the hood. We need to figure out the specific financial misses, the strategic changes management talked about, and that really cautious guidance that just triggered this huge volatility. This wasn't a minor dip.
No, not at all. And when you look at the Q4 numbers themselves, well, you can see why the reaction was so strong. The headline figures were, frankly, pretty poor.
Yeah.
Adjusted EPS came in at 0 for 6 cents. That missed the $1.48 consensus. But honestly, that wasn't even the number that really spooked the market.
That would be the GAAP loss, I imagine.
Exactly. GAAP EPS was negative $0.12. And that was mostly driven by a massive non-cash impairment charge. We're talking $60.9 million here. And crucially, this wasn't some general charge. It was specifically tied to the Atkins brand intangibles, basically management writing down the value of that legacy asset.
Right. That impairment alone is a huge signal. Okay, but let's look at the top line first. Revenue was $369 million. Looked okay, maybe in line, but the year-over-year number was actually down 1.8%. And that decline is a bit tricky, isn't it? Because last year's Q4 had an extra week.
That's right. So if you adjust for that extra week, apples to apples, revenue was basically flat. Any, underlying growth was kind of hidden.
Okay, flat revenue you can maybe live with, but the profitability, that seemed to be where the real damage was done. Gross margin contracted sharply.
Oh, brutally. It dropped 450 basis points compared to last year, landing at 34.3%. I mean, for a company selling premium nutritional products, losing that much margin is just devastating. It screams pressure from input costs, tariffs, just squeezing them hard.
And if you lose 450 basis points up top, it flows right down. Adjusted EBITDA took a hit too?
A big one. Down 14.5% year over year, came in at $66.2 million. The numbers really paint a picture, don't they? Inflation's running hotter than their pricing power, plus the drag from that Atkins brand they just impaired.
So the natural question is, why stick around? Management's pitch is that this is, painful but necessary strategic cleanup.
That's absolutely the line they're taking. They're essentially managing two different speeds of business now, all under one roof, and they're leaning on the overall category trend, which is still strong: high protein, low sugar. That category grew 13% overall in fiscal 25, so the demand backdrop is still good.
Okay, let's break down that two-track idea. Management seems clear. Quest and OWYN are the growth driver.
Exactly.
And, the legacy piece. Quest is the big one, right? Almost 2/3 of Q4 sales. How's that holding up?
Quest is still looking really solid. Consumption grew 11% in Q4, and it was 12% for the full year. That's your growth engine right there. And what's really interesting is how they're driving it. They keep finding new places for that high-protein, low-sugar promise to work.
Like the salty snacks portfolio within Quest. That seemed like a real standout. Consumption growth surged 31% in the quarter. That's huge velocity.
It's massive, and you can tell management sees it as absolutely critical because they confirmed they're expanding capacity for Quest salty snacks again. That's the second time in 2 years. They are clearly pouring resources into that winner.
Okay, makes sense. Doubling down.
Absolutely. And then you've got OWYN Only What You Need. That's the plant-based protein brand they bought. OWYN's consumption up 14% in Q4 and a really impressive 34% for the full fiscal year. Management said the integration is pretty much done and they're tapping into that whole plant-based trend effectively.
All right, so two brands cranking out double-digit growth, but the overall company just posted this awful margin contraction, which brings us right back to Atkins. That $60.9 million write-down tells part of the story, but what's the actual plan there?
The plan is, it's simple but painful. Shrink to stabilize, essentially. Atkins consumption dropped 12% in Q4, but management is framing this as a deliberate move. They're working with retailers to, and this is their phrase, right-side Atkins space.
Hang on, right-side Atkins space. That sounds like some serious corporate speak. What does it actually mean for someone looking at the shelf? Are they just getting less space?
Pretty much. It means they're accepting less distribution. How? By cutting the tail, the slower-moving SKUs, the ones that just sit there. They're cleaning house, focusing only on the products that really sell, even if it means less shelf presence in the short term.
Okay, actively shrinking the footprint. And what does that mean for next year? What are the implications of this rationalization?
This was another big shocker in the guidance. Management expects Atkins consumption to decline another 20% or so in fiscal 2026 as they keep doing this. Just think about that. They're forecasting a 20% revenue drop from a major brand for the whole next year. It really confirms Atkins isn't about growth anymore. It's about managing a decline, hopefully profitably.
Wow. Okay, so just as the market's trying to digest this planned shrinkage of Atkins, the other growth engine, OWYN, hit a bit of a snag. They mentioned slower consumption growth recently.
Yeah, a bit of a speed bump there. They traced it back to a specific product quality issue.
Ooh, what happened?
It was related to a pea protein sourcing decision, and interestingly, it happened before Simply Good Foods even bought OWY. Apparently, this particular pea protein negatively affected the taste and texture in some batches. They estimated maybe 10% of the product, and consumers noticed. It showed up pretty quickly in ratings and reviews, and that slowed things down.
Ooh, that's tough in CPG. One ingredient change can really mess with momentum. Have they fixed it now?
They say they have. The issue's been mitigated, the formulation is stable again, it's shipping now, but they did acknowledge they'll need to spend a bit more on trade and marketing, to kind of reassure people, rebuild that trust, and get OWYN back onto that faster growth track they were on before.
Okay, so two strong brands facing some temporary issues, a legacy brand being deliberately shrunk, all happening against this backdrop of tough inflation, which leads us directly into the fiscal 2026 outlook. That was the other big reason the stock got hammered, right? The caution there.
Extreme caution. Net sales guidance for FY26, they're expecting between -2% and +2% year over year, basically flat, which, as you said, is a huge disconnect from the strong category growth out there. Adjusted EBITDA is similarly muted, expected somewhere between a 4% decline and maybe a 1% increase. Pretty much a zero growth forecast for the next year.
And the margin pressure isn't finished either. They're guiding for gross margins to fall another 100 to 150 basis points in FY26. What's driving that ongoing hit? Is it still tariffs?
Tariffs are part of it, yeah, but maybe not the main driver this time. They said the blended tariff rates are a bit higher than they thought, but total tariff exposure is still pretty small, less than 2% of COGS. The really big culprit for FY26 margins, especially early on, is cocoa. They had to lock in cocoa contracts at, quote, historically high prices just to guarantee they'd have supply for their chocolate products. That decision means they're stuck with really high raw material costs that are going to weigh heavily on the first half of the year.
Right. So even if spot cocoa prices crash tomorrow, it doesn't help them immediately because those expensive contracts are locked in, which makes this whole H1 versus H2 story absolutely critical for how the stock might perform.
It's the definition of a tale of two halves. The first half of FY26 looks set to absorb basically all the bad news at once. You've got the initial consumer pushback, the elasticity from the price increases they just took across all three brands. You've got the continued drag from Atkins losing shelf space. And then bam, those super high cocoa costs and the tariffs hitting all at the same time.
And they were pretty specific about how bad Q1 could be, weren't they?
Brutally honest, actually. They expect Q1 gross margins to bottom out around 32.5%. That's nearly a 600 basis point drop year over year. Just ouch. And consequently, they expect Q1 adjusted EBITDA to be down about 25%, 600 basis points of margin erosion, and a 25% EBITDA decline. That's the kind of near-term pain that craters the stock and leads to a wave of downgrades.
Okay, that does sound like a real gut punch for the first half. But management is obviously betting hard on a big second half turnaround. Why should investors believe that recovery story, especially after they just missed estimates this quarter?
Well, they did try to lay out some concrete reasons for why things should improve sequentially. They're pointing to productivity initiatives kicking in, the price increases starting to stick and flow through fully, and maybe most importantly, they've apparently secured cocoa coverage for the second half at rates below this past year's levels.
So the really expensive contracts finally roll off, and they get relief later in the year.
Exactly. So they think this could lead to actual gross margin expansion by Q4 of 2026. Think about that trajectory shift from EBITDA down 25% in Q1 to potentially strong double-digit EBITDA growth by Q4, if, of course, everything lines up as they hope.
It's really important, I think, to frame all this pain and investment against their financial position. Because unlike some companies facing these pressures, Simply Good Foods isn't exactly struggling for cash, are they?
Not at all. Their balance sheet looks quite strong, actually. Net debt to adjusted EBITDA is super low, around half a turn, 0.5x. And they generated good cash flow from operations last year, $178 million in FY2025. So they definitely have the financial cushion to absorb this H1 hit and fund the strategy.
And they seem to be using that strength to send a message, right, with the buyback.
Absolutely. The board approved a big $150 million increase to the stock repurchase program. That leaves them with about $171 million authorized for buybacks now. In the middle of all this volatility, that's a pretty clear signal to the market that management thinks the stock is cheap down here.
And they're not just buying back stock, they're also investing in the growth parts. CapEx is going up.
Yeah, up to $30 million to $40 million in FY26. And most of that is earmarked for that Quest salty snacks capacity expansion we talked about. They clearly see that as building a competitive moat, protecting and feeding the part of the business that's really working well.
So you really see the disconnect here. Management's playing the long game, investing in Quest and OWYN, talking about an H2 recovery based on costs getting better. But the market, it's laser focused on the immediate pain. The flat guidance, Atkins shrinking, and that awful Q1 margin forecast. That short-term fear is just dominating right now. Okay, now for our regular segment. This is not financial advice, just a reminder, we're breaking down an earnings call here. Don't base any investment decisions solely on this chat. But if we were putting on our hedge fund hats, pitching an outrageous but plausible trade idea based only on what we heard in this call, how might that sound?
Okay, yeah, not advice, just thinking aloud here. The core idea would be a trade structured around timing, specifically that huge H1 versus H2 difference we've been talking about. It relies on the market maybe not fully appreciating just how stark that difference is likely to be and how markets tend to react badly to sequential bad news.
So the rationale is really pinned on that upcoming Q1 report.
Exactly. Q1 and probably Q2 are set up to take the full brunt of the bad stuff. The worst of the cocoa costs, the tariffs, the peak Atkins shrinkage pain. With management guiding Q1 adjusted EBITDA down roughly 25%, consensus estimates have to come down hard. It feels likely the stock could take another leg down when those actual Q1 numbers hit the tape.
Right, so the actual trade pitch.
The pitch would be kind of tactical, maybe a two-step move. Potentially initiate a short position now, or at least sell any existing long position. Then you'd be looking for a tactical reentry point, probably somewhere near the bottom, maybe right before or just after those Q1 or Q2 results are out, and the bad news is fully priced in. The goal of re-entering then would be to position the portfolio to catch the full updraft from that anticipated H2 recovery, capturing that potential double-digit EBITDA growth in Q4 26 as costs ease and the growth investments pay off. It's basically a bet that the market overreacts to the H1 pain, but will eventually have to reward the H2 recovery.
Okay, that definitely fits the outrageous but plausible category.
Yeah.
So wrapping up our deep dive on Simply Good Foods, the core tension here seems crystal clear. You've got a company with two really strong growth brands, Quest and OWYN. They've got a solid balance sheet, good cash flow. But they're trying to manage this tricky Atkins turnaround while navigating some really nasty commodity and margin headwinds for the next, say, 6 to 9 months. That's the test.
Right. And the key question left for you, the listener, having heard all this detail, is really about that Atkins impairment. Was that $60.9 million chart the final kitchen sink moment? Does it finally allow the market to look past the legacy drag and properly value Quest and OWYN? Or does that guaranteed Q1 pain, that big margin hit coming, mean the stock is just kind of dead money until we actually see proof of that turnaround materializing? Probably sometime around Q3 of fiscal 26. That's the debate.